Hello everyone, welcome to my channel. Today I'm going to talk about the IRS money. How long do they have to collect? Let's get into the video. Have you ever wondered how long the IRS has to question and assess additional tax on your tax returns? For most taxpayers who reported all their income, the IRS has 3 years from the date of filing the return to examine them. This period is termed the statute of limitations. But wait, as in all things taxes, it's not that clean cut. Here are some complications. You file before the April due date. If you file before the April due date, the 3 year statute of limitations still begins on the April due date. So filing early does not start an early running of the statute of limitation. For example, whether you file your 2021 return on February 15, 2022 or April 15, 2022, the statute does not start running until April 18, 2022. That's not a mistake. The due date for 2021 return was delayed from April 15 to April 18 because of a holiday in the District of Columbia, Emancipation Day, and a weekend, and the April 18th date applies even if you do not live in DC. But there is a further exception for residents of Massachusetts and Maine. The due date for 2021 return is April 19, 2022 because of holiday observed in both of those states. So for residents in these two states, the statute of limitations for 2021 return begins on the 19th. You may recall that due to COVID-19 pandemic, the IRS extended the original due date to May 17, 21 for 2020 returns and to July 15, 2020 for 2019 returns. As a result, the statute of limitation for refunds expires May 17, 2024 for 2020 returns and July 15, 2023 for 2019 returns. You file after the April due date. The assessment period for a late file return starts on the day after the actual filing, whether the lateness is due to taxpayers' delinquency or under a file extension granted by the IRS. For example, say your 2021 return is on extension until October 17, 2022, and you file on September 1st, 2022, the statute of limitation for further assessments by the IRS will end on September 2nd, 2025. So the earlier you file those extension returns, the sooner you start the running of the statute of limitations. If you want to be cautious, you may wish to retain verification of when the return was filed. For electronically filed returns, you can return the confirmation from the IRS accepting the electronically filed return. If you file a paper return, proof of mailing can be obtained from the post office at the time you mail the return. You file an amended tax return. If after filing an original tax return, you subsequently discover you made an error, an amended return is used to make the correction to the original. The filing of the amended return does not extend the statute of limitation unless the amended return is filed within 60 days before the limitation period expires. If that occurs, the IRS generally lasts 60 days from the receipt of the return to assess additional taxes. You understated your income by more than 25%. When a taxpayer underreports their gross income by more than 25%, the 3-year statute of limitation is increased to 6 years. In determining if more than 25% of income has been omitted, capital gains and losses ain't netted. Only gains are taken into account. These omissions do not include amounts for which adequate information is given on the return or attached statements. For this purpose, gross income, as it relates to a trade or business, means the total of the amount received or occurred from the sale of goods or services without reduction for the cost of those goods or services. You file 3 years late. Suppose you procrastinate and you file your return 3 years or more after the April due date for that return. If you owe money, you will have to pay what you owe plus interest and late filing and late payment penalties. If you have a refund due, you will forfeit that refund and perhaps get stuck with a $450 or more minimum late filing penalty. The amount is adjusted for inflation each year. No refunds are issued 3 years after the filing due date. You haven't filed at all. In situations where no tax return has been filed or there is fraud, the willful intent to evade tax, there is no time limit for the IRS to assess the tax or additional tax or to take court action. 10-year collection period. Once an assessment of tax has been made within the stationary period, the IRS may collect the tax by levy or court proceeding started within 10 years after the assessment or within any period for collection agreed upon by the taxpayer and the IRS before the expiration of the 10-year period. Discarding tax records. Remember not to discard your tax records until after the statute has run its course. When disposing of old tax records, be careful not to discard records that prove the cost of items that have not been sold. For example, you may have placed home improvement records in with your annual receipts for the years the improvement was made. You do not want to discard those records until the statute runs out for the year you sold the home. The same thing applies to purchase records for stocks, bonds, reinvestment dividends, business assets, or anything you will sell in the future and need to prove the cost. And a word of caution about discarding those tax records: to limit your exposure to ID theft, be sure to dispose of the documents safely and securely, such as by shredding paper files, or if the records are stored on your computer, delete them, or by destroying the hard drive when you take the device out of service. State statute of limitation. Most, but not all, states follow the federal 3-year statute of limitation and 10 years collection period rules. If you or your company needs help with preparing your tax return, feel free to contact me. My contact information is listed below in the description of the video. Thanks for watching this video and do not forget to subscribe to my channel.